just like we had over here, we had a disruption. We have a disruption down here. So where is their relative equal highs? Here and here. So what are we looking for? We want to see if it can muster the ability to poke its head above high of the day over here. We have inefficiency here. This could be an immediate rebalance. We also have this fair value gap here. In this case, I'd like to see this fair value gap stay open, not traded entirely down into that candle's high, and then reach up here. And here you go. It pans out. That was a immediate rebalance. Immediate rebalance is here. It trades down, touches the candle, rallies up, and then we have a order block. It trades down into that, and then it expands up to there. And then the next candle is it rallies up, and then it's trading back down into this down close candle, which is an order block. It rallies up. It completely closes in this inefficiency. One more time, taps into it there, and then finally reaches up. I would absolutely be done. I wouldn't touch anything the rest of the day. But I want to drop down into a 15-second and kind of tell you what I was talking about as we started this live stream. So here's the 5-minute price run in here, okay? And this is the immediate rebalance right there. So I'm going to draw a little line on that. And now we can take our attention over here. So I annotated everything that I was talking about and expecting on the 1-minute chart real time with you. And now we're inside this price run. So I'm going to talk about the price delivery continuum theory, where you have an expectation where price is going to gravitate to, and it gives you a continuous opportunity for you to be a participant in it, because the markets are fractal. They're going to offer you setups on one time frame, and then that time frame has, once it's expired all of its opportunities that's used for an entry mechanism, you can't do anything else unless you're going to just chase price. I don't chase price. Okay, I'm going to show you how you can effectively and efficiently use a 15-second chart. Should you ever want to do so, you don't have to. As I was showing on the 1-minute chart, it was likely to come back down and touch the top of the candle and then start to expand up into this blue level. Okay, that was the initial high of the day, right at 7 o'clock in the morning, using the morning session. And if you look at what was happening here, it traded up and then came right back down. See that? What is occurring there? It's coming right back down, and it's rebalancing the inefficiency of this quick sudden price run from this close to that close. That's what's occurring. So what the algorithm does, it refers back to that price point at that time. And this is what goes on. The market algorithm starts from a higher time frame and refers to key price points that are salient to where it's at right now. At given sets of time, as I'm teaching you here, it will refer to close proximity points of reference. And that means things like this, where we have a quick sudden run like this in a 15-second chart, in a 5-second chart, a 1-second chart. It's cycling through very, very fast. The mechanism that's it's going through all these calculations so fast you can't keep up with what's actually going on. This is what you have. You have this visual representation of it, where it's likely to draw to this level and just above it. It comes back down, and where there's an absence of a fair offer for buying on a down tick. Okay, you ever hear how like when the circuit breakers go off on the market, where it goes too far one direction, there's a circuit breaker, they halt trading. Say, for instance, the market goes down too fast, too much at one time, and they pause trading until the market starts to tick up. Okay, there's a lot of high frequency trading algorithms that operate and engage in the marketplace like that. So they're filtering out they're not trying to buy when the market's expanding up. But what their algorithm seeks is these inefficiencies here. And then once they get inside that range, once it meets that threshold of trading into it, then once that's met, then it trades the first down tick after that. And then their algorithm fires entry orders to get long, knowing that the algorithm is repricing here. It's not volume that's moving price. Volume precedes price. What does that mean? There's going to be a lot of volume in this area down here. Why? What's below here? Sell stops. So volume will be larger here than it will be in here, because this is all discovery. This is all going to levels that are outside the range. And while there might be buy stops above this blue line that I indicated, the further above that line we get, the less volume there will be, because everybody wants to have a stop loss real close to a level. And it's thinner as it gets up here. And that's why you start to see the price start having all these big gaps, because it's pressing higher and higher and higher. The algorithm is just going to reprice higher. whether you want to be a buyer or everybody collectively wants to be a buyer or not. It's programmed to keep offering that price because someone is always coming in with a sell order at market and a buy order at market. And guess what that does? It gives you the counterparty, and it's going to book price. So in here, we have price dropping down to overlap this inefficiency. There's no gap in here, is there? Is there any gap in here? Sure there is. Relative equal highs. Here, fair value gap. It trades outside of it, comes back down into it here with a 1 minute immediate rebalance. So it's trading down to a deeper discount. So this is your first return in after taking the buy side here, but this is left intact. So this is still in play. So it's dropping down. That right there would have been a 15-second long for me. If I would have been buying down in here, or if I was long here, this would be another area where I could go long and add another partial. But it couldn't be larger than one contract. Why? Because we're long in the tooth with the price run, and my limit order would be just above here. It wouldn't be up here. So let's say I missed this opportunity to be long there. Okay. We have a down close candle inside of a fair value gap that came back down into an old inefficiency as well after the first run above here. When it trades back down into this down close candle here, that could be a buy for me as well. That one, and we can look at this little gap right there. See that? That's all it takes. It trades down to here. My limit order would be just above midpoint of that wick. I'm not demanding it gets me filled in there because I may not get it. So I'll be a little bit more forgiving in placing a limit order there. And then I could use that to get in sync with the run. The 15-second chart affords you that as a mechanism, okay? It also gives you the ability to reduce your stop loss, okay? Make it a little bit tighter.